Have you ever watched the forex market and felt like it was speaking a different language? You're not alone. Today, we're breaking down one of the most important yet confusing concepts every trader needs to master: market pullbacks. Think of pullbacks as the market's way of catching its breath before continuing a marathon. Whether you're new to trading or looking to sharpen your skills, this video will simplify how to spot these pauses, avoid common traps, and make smarter trading decisions. Let's dive in. What exactly is a pullback? First things first, what is a pullback? Imagine you're driving up a hill, and suddenly, the road dips slightly before climbing again. That dip is like a pullback in an upward trend. In trading terms, it's a temporary pause or reversal against the main direction of the market. Pullbacks happen because markets rarely move in straight lines. Buyers and sellers constantly battle for control. Even in a strong uptrend, sellers might temporarily push prices down before buyers regain momentum. The key word here is temporary. A valid pullback doesn't reverse the trend, it's just a pit stop before the trend resumes. Why does this matter? If you can spot a pullback, you'll know when to expect the trend to continue, avoid panic selling, or even find opportunities to enter a trade at a better price. But be careful. Not every dip or rally is a pullback. Some are traps. Let's learn how to tell the difference. To understand pullbacks, we need to talk about three basic market movements. 1. Impulse moves, strong, decisive price movements in one direction, like a sprint. 2. Corrections, short counter moves against the trend, like stepping back before jumping farther. 3. Continuation patterns, signals that the trend is likely to keep going. Here's how they work together. In an uptrend, prices surge upward, impulse. Take a small step back, correction. And then surge again, continuation. The pullback is that correction phase. But how do we know if it's a valid pullback and not the start of a full reversal? Let's find out. Spotting valid pullbacks. Valid pullbacks follow specific rules. Let's break them down with examples. Rule 1. The price must break a key level. In an uptrend, a valid pullback occurs when the price drops below the lowest point of the most recent upward surge. In a downtrend, it's when the price rallies above the highest point of the latest downward move. Think of this as the market testing a boundary. If it doesn't break through, it's just noise, not a true pullback. Rule 2. Look for order blocks, aka decision zones. Order blocks are areas where buyers or sellers previously showed strong interest. For example, in an uptrend, a valid pullback often reverses near a demand zone where buyers stepped in before. If the price reaches this zone and bounces back, you've likely found a valid pullback. Rule 3. Avoid false breaks. Sometimes, the price will briefly break a level but quickly reverse. This is a trap. To confirm a valid pullback, wait for the price to close beyond the key level, not just touch it. Let's see this in action. Example 1. Valid pullback in an uptrend. Here's a steady uptrend. Notice how each upward surge of green candles is followed by a small dip of red candles. But none of these dips break the low of the previous green candle until this one. When the red candle finally closes below the prior low, it signals a valid pullback. The price then finds support at the demand zone and resumes climbing. That's your cue to stay in the trade or even buy the dip. Example 2. Invalid pullback in a downtrend. Now look at this downtrend. Sellers are in control, but suddenly, a few green candles appear. Do they signal a reversal? Not so fast. None of these green candles close above the prior high. Without breaking that level, this is just a temporary pause, a fakeout. Sure enough, the downtrend continues. Knowing this could save you from a bad short-term trade. Now, let's look at 3 types of pullbacks and how to trade them. Not all pullbacks are created equal. Let's explore 3 common types and strategies for each. 1. Aggressive pullbacks, the speedy U-turn. What to look for? Sharp, fast reversals, e.g., 2 large red candles in an uptrend. Risk, these can be traps. If the price slams into a key zone without slowing down, it might blow right through it. Strategy, wait for confirmation. Let the price settle near the demand/supply zone and show signs of reversing, e.g., a bullish candle closing strong. 2. Corrective pullbacks, the slow retreat. What to look for? Gradual dips with smaller candles, like stairs going down in an uptrend. Opportunity, these are safer to trade. The price is pausing, not panicking. Strategy, place a buy limit order near the demand zone. If the price respects the zone, you'll catch the rebound. 3. Sweeping pullbacks, the liquidity hunt. What to look for? The price briefly spikes beyond a key level to sweep stop losses before reversing. Ready to apply this? Here's your game plan. 1. Identify the trend. Is the market moving up, down, or sideways? 2. Mark key levels. Note the highs/lows of the latest impulse move. 3. Wait for the break. Does the pullback close beyond the key level? 4. Check the zone. Is the price near a demand/supply area? 5. Look for confirmation. Use smaller time frames to spot reversal patterns, e.g., a bullish engulfing candle. And remember, practice makes progress. Start by reviewing past charts without placing trades. Train your eye to spot valid versus invalid pullbacks. Over time, it'll become second nature. Trading isn't about predicting the future, it's about preparing for it. By mastering pullbacks, you'll navigate markets with more confidence, avoid emotional decisions, and spot opportunities others miss. If this video helped you, hit the thumbs up button. It lets us know what content you love. New here? Subscribe and join our community of traders learning together. Drop a comment below. What's the #1 thing you struggle with in trading? We'll tackle it in the next video. Thanks for watching, and remember, every pro was once a beginner. Keep learning, stay patient, and happy trading.